Hello, everyone. Welcome to today's Financial Talk. My name is Michael Mandarino, financial advisor with 123 Investing LLC. A little bit about myself. I've been a financial advisor since 2002. I was blessed to go to the United States Military Academy, served most of my time overseas in Germany and Bosnia. I'm blessed to have a special guest today, Mr. Peter Coppa. Peter, how's it going, brother?
Hi, Michael. Going great over here. Thanks for having me.
Yeah, awesome. Yeah, great to have it. And as a financial advisor, I'm going to go through some quick disclosures. So, securities are offered through GA Repo and Company. That's my broker dealer. This is not an offer to buy or sell security. This is for informational purposes. Past performance is not guaranteed of future results. I'm also not a tax advisor. I do not offer tax or legal advice. Neither does Peter. But Peter, so glad to have you on the call today. Really looking forward to our discussion. So, how's it going today?
We're doing well here. We over here at Alternative Access, we are excited about what's been going on in the world. There's been a lot of motion in the interest rate environment, specifically a lot of clamor about, Federal Reserve and different governors, so we live in an interesting time, and it makes us feel useful because we think our products kind of can help folks deal with those sorts of things.
Excellent. And, forgot to do the quick introduction, but Peter is the founder and portfolio manager at Alternative Access. And we're looking forward to him to do a deeper dive to understand a little bit more about collateral loans. So, Peter, let us know what's going on with Alternative Access and tell us a little about collateralized loan obligations.
Sure. Yeah. So Alternative Access is quite a literal name. We had alternative access to come from the hedge fund industry, credit hedge fund industry, and about 5 years ago, we started Alternative Access with the idea of bringing credit hedge fund strategies to kind of a broader market. And our first product is AAA, which is as Michael referred to, is a collateralized loan obligation ETF.
Excellent, perfect. And tell us a little bit. What is the ETF that you're working with? What is your space? You want to do a little deeper dive? Do you have some information you want to share? You can go ahead and share your screen if you want to.
Sure, yeah. So AAA is our first ticker. It's an NYSE listed ETF, and it was and is the first CLO ETF that was ever created. We started in 2020, September of 2020, so we're coming up on our 5-year anniversary here. It is the first ETF that took collateralized loan obligation bonds and put them in an ETF for folks to easily access via their brokerage accounts through trading on the NYSE.
Perfect. And Peter, a little bit about, so two things on there. I had a question on what is first priority? What does that mean? But even taking a step back, what is an exchange traded fund for those that might not know what an exchange traded fund is?
An exchange trade fund is a kind of a derivation of a mutual fund. They've started, most people are familiar with like the SPY or the QQQ. Those are funds that give people access to a big portfolio of stocks or bonds, and they trade, every minute of every day that the exchange is open, as opposed to a mutual fund where those funds are not traded, and don't necessarily represent the what's going on intraday in the market. So those funds will have NAVs that get set at the end of the day, and only liquidity provided at the end of the day. Where an ETF, as the name implies, is exchange traded, and you can trade it throughout the day. And for days where it's volatile or not volatile, you can come in and out of the ETF as needed.
Excellent. Thank you for that. And you've been in the industry for how long again, Peter?
Yeah, so going on, this is my 25th year in the industry.
Congratulations.
and been in and around the credit markets for a long time, and the interest rate markets, and have been a part of uh, kind of more downturns and volatility than I'd like to admit. But it's provided a great experience for us here at Alternative Access, and what sort of products we get to offer people, and what we think is interesting for people to own, and how we can help folks really, with their portfolios.
Thank you. And you said you were the first to the market. So how did you see that niche? Talk a little bit about like why you saw this as a need, and also not a need just to even create an ETF, that there's going to be other folks that really need this. So you want to share a little bit about, what is AAA, and what was the need that you found?
Yeah, it's interesting. After leaving the hedge fund world, doing some reflecting, I was looking for a product that, could provide, at the time it was 2019, where zero interest rates were a real thing. We don't have that scenario
Remember
right
those days?
now. Yeah, exactly. I mean, ZERP, as it was called. And I was looking for a place to get more yield. And I had been an investor in CLOs for a long time, most of my career, along with other credit related products. And I was like, wow, it would be great if we could get, as an individual, if I could get access to AAA rated CLOs. They're short duration, they're ultra short duration because they're floating rate bonds, and they offer excess yields in that space that you couldn't otherwise get in other places.
Okay, perfect. Awesome. Yeah, I love the obviously that's looking forward to doing a deeper dive here today. And for those who are on the call, and are listening in, I can be reached to be able to help within your portfolio. Or if there's any financials advisors out there that want to see how this may fit for your clients, Peter will be able to share his website information later. So, Peter, let's get into a deeper dive. Like, let's go into the depths. What is AAA?
You know, um, Kind of very simply, I mean, AAA is the ticker for the ETF, the Alternative Access First Priority CLO Bond ETF. I know that's a mouthful, but if we break it down a little bit, Alternative Access is our name. First Priority refers to the fact that it's the top of the heap in terms of the CLO structure. A bond is a financial instrument that pays interest and your maturity at a set date, and your principal back at a set date. And an ETF, as we went over before, is an exchange traded fund. So that's what it is. Our fund specifically, AAA, invests in only AAA rated assets. So the best of the best when it comes to risk profile, as determined by Moody's and S&P and Fitch or other rating agencies. We invest only in what are referred to as broadly syndicated CLOs, meaning it's a big, wide portfolio of CLOs, and the underlying collateral are broadly syndicated loans. Those are loans that used to be made by banks to basically PE shops to kind of fund their acquisitions of various assets.
And going down a little deeper, what is just the very basics? What is a CLO for those who want to maybe understand a little bit more in depth?
Yeah, like I said before, CLO, it's a special purpose vehicle, which that's also a mouthful. But it's a little corporation that owns a portfolio of loans. Those loans are, what are called syndicated. So a bank will originate a loan, or a private lender will originate a loan to, let's say, American Airlines, or an electric company, or a driller, or you name any variety of industries,
Mm-hmm.
and then that loan gets sold to all sorts of different folks. It gets sold to insurance companies, it gets sold to banks, it gets other banks, it gets sold to these special purpose vehicles, these little corporations. They get sold to CLOs, and the portfolio manager at the CLO buys a whole bunch of these loans, and they package them up, and then they chop up the risk into little pieces. called tranches. I think tranche is a French word for slice.
Okay.
And so the various slices have various risks associated with them based upon how much subordination they have. So the AAA rated slice, it basically has access to the whole portfolio of loans, but we only lend on about 66% of the portfolio. So we're over collateralized by approximately 50%. So that gives us a lot of leeway, for if there are any losses in that loan portfolio, that we don't have losses associated with. And that's why the rating agencies give us a AAA rating, because the probability of there being a principal loss or missed payments is very, very low, extremely low. Matter of fact, the way I describe it to most folks is, we'd have to have, kind of, if you think about kind of the mid cap and small cap universe, if all of those companies went bankrupt at the same time and they all returned, less than 60 cents on the dollar on their obligations, then a AAA CLO would start to take a loss. So that's like a wild scenario, right? You would have to have, acts of God, right, in order for that to happen. So that's why AAA CLOs get a AAA rating, because they're very well protected by the subordination.
Excellent.
So
And that's really good. And for those that are actually can see the screen, I like right in the middle, Peter. If you can kind of like how you show the AAA and you show it going down. And I know for when I'm helping folks with their own risk score analysis, I can't control what the stock market's going to do, but I can control how they're going to feel. So I like that slide like right in the middle where you have the equity at the bottom. With when it comes to explaining risk, the more risk, the potential more reward. Is that kind of the same thing as what that middle of that slide showing that, the top you have the less risk, less reward, and then the more risk you're willing to take, the potential more reward. Can you talk a little bit more about the AAA versus AA A rated?
yeah, sure. So, actually, so the center of the slide there gives you kind of how what we call the capital structure looks like for a CLO, right? The AAA rated bonds, and then the various tranches: AA, single A, triple B, double B equity. And if you look to the right, you could kind of see what characteristics each of those tranches, each of those slices has. So in terms of who gets paid first, the priority of payments, the first payment, the first dollars that come out of that portfolio go to the AAA rated portion there. And then the the first loss goes to the equity, right? They're the ones that take the most risk. AAA CLOs take the least risk, right? And that's why they get rated AAA.
And in that scenario, the equity would be like if you actually own stock in a particular company. Is that where you were? Okay, excellent, perfect.
That's exactly right. Like you own stock in a particular company. CLO equity, is also is also an asset that people trade. We don't offer it here, but you can get access to that through other vehicles.
Very, very good. That was a very, very good rundown. I appreciate that. I understand you guys are a floating rate note. What does that? Can you explain a little bit about floating rates and what does that look like in your world as far as why people would go to use you as an investor?
Yeah. So what's interesting, again, back when we started the fund, like we had, we were in the middle of the ZIRP period, the zero interest rate period, and CLO bonds, AAA CLO bonds pay what's called, well, at the time it was LIBOR plus a margin or credit spread, right? When LIBOR was effectively zero in the zero interest rate world, which is now referred to as SOFR, or which is now SOFR, what is the reference rate now, but um, you know, when SOFR or LIBOR was zero, AAA rated CLOs were offering 100, to 125, and they still offer 100 to 125 basis points more than what you get, in the zero interest rate world, or in the world today, actually. So when we started, we said, hey, I would like to get paid more for things, for the least risky portion of my portfolio, right? For places where I feel, I want more safety, but I don't want to get paid zero like I would if I was buying a treasury bond or other bank assets or things like that. So AAA rated CLOs offered that incremental yield. Now, the other bit about AAA CLOs is, like you said, Michael, is that they're floating rate, which means as interest rates go up because there's inflation, which we've all had, and the central bank raises interest rates, a normal bond, well, it just maintains, it's a fixed rate bond, just maintains the same coupon. So if you bought a fixed rate bond at 50 basis points, let's say a 50 basis point coupon, well, you're going to get paid your principal and you're going to get paid 50 basis points per year. A floating rate bond, though, every quarter resets its coupon, which means that, as SOFR rises or as interest rates rise, the coupon for a floating rate note also rises. It goes up. And so when SOFR went from zero effectively to 4.5%, 5%, the coupons on floating rate notes went from their credit margin plus SOFR to 4.5% and 5% plus their credit margin, right? And so at the time, at the peak, AAA CLOs, the coupon on AAA CLOs were close to, 6.5, almost 7%, which is it's a big number. And then even today, even though interest rates have come down a bit, AAA CLOs are still offering 5.25 to 5.5% type credit coupons, which is pretty interesting. And
That's as today's recording. This is for those listening maybe later on. This is today's date is August 7, 2025. So Peter, you want to talk a little bit more of where this would fit into someone's portfolio, and talk about the differences of your CLO AAA as far as risk versus reward compared to, let's say, government money market accounts. And is it fair to say, as far as for advisors out there, or folks who are don't know where interest rates are going, it's probably a good thing to have something in floating rates, especially if they're conservative investors, but also have something in fixed rates in case the rates do come down? Is that kind of your understanding as far as good diversification? Because you don't really know what's going to happen with interest rates, correct?
We really don't know what's going to happen with interest rates, but let me talk about where it fits in your portfolio first, and then I'll talk about interest rates a little bit.
I'm piling on a lot of questions.
But where it fits in your portfolio, look, AAA, it's really for everyone, honestly. Anyone who has any near cash type, allocation, anyone who uses, like a money market or a short duration bond fund, or, someone who doesn't want to take a lot of risk for that small portion of, for that, or depending on what environment you're in, or what situation you're in, that portion of your portfolio where you're like, I want to take less risk and still get paid a certain amount of coupon, then this is a perfect product for you, right? AAA. And it's easy to access, like I said, it's on the NYSE. You go in, call up your broker, tell, hey, I want to buy AAA, the ETF AAA, and you allocate, that near cash type asset to AAA, and you buy that amount of shares. When we think about other kind of near cash product, this, I think this little matrix gives like a good indication of what's going on. There's basically kind of four categories according to Morningstar in the investment grade space. Meaning investment grade, meaning bonds that are rated BBB or higher. And that's the ultra short duration space, the short-term bond space, short government space, intermediate government space. So those are things where you have the least interest rate risk. AAA rated CLOs broadly, they out yield, they offer bigger coupons than the rest of the space writ large, right? And often to the tune, like I said, anywhere from 100 to 150 basis points, depending upon the kind of what's going on in the environment. And so that's kind of the benefit of AAA, right? It's like, well, you can kind of have your cake and eat it too a little bit, where you get some extra yield and you're still in a highly rated asset. And what's interesting is, as you pointed out, Michael, is that, well, what happens, you're in a floating rate bond, it's AAA rated, but what happens when interest rates go down? And the short answer is, well, then our coupons do go down. That is fair. But we are paying, 100 to 125 basis points or 150 basis points more than other products. So, those products yields are also going to come down there. And because they're short duration, you're really not going to make that much up in principal appreciation. So our product offers that kind of best of both worlds, right? Where you're always getting paid a little bit more, and you're not really taking that risk. That's what's incredible about it. And like you said before, interest rates, we don't really know where they're going. CPI, yes, has been coming down, but Purchasing Managers Index, I mean, it's been going up recently. Inflation indicators are not consistent, and we have tariffs and all sorts of kind of funky things going on in this economy, that the direction of interest rates is not 100% certain. I know, obviously, there's what do you do in a stagflation environment? Last time we had a stagflationary environment, interest rates were very high. And so, it's not a sure thing that we will see lower interest rates. I know, there's various leaders or who whatnot that want to see lower interest rates, and I understand, the dual mandate of the Federal Reserve, in terms of the labor market, as long and inflation. But what happens when they're at odds, right? And it's hard. So I'm not. The great thing about floating rate bonds and about AAA rated CLO bonds is that you don't have to worry about it so much, right? You could just sit back and say, okay, you know what, like I'm going to be paid a decent amount regardless.
Perfect. And for those that aren't able to see the slides, Peter's been talking about, less than 5 year duration. So as an advisor, when we look at the best interest or fiduciary responsibilities for our clients, we have a lot of factors. One of it is liquidity. So obviously a longer term bond, you tend to lose the liquidity. But then also the other thing you have is duration risk. And duration risk is, if you're having something that's a long-term bond, well, and interest rates start rising, well, then you got stuck in a longer-term bond. And I think that's where it's a great fit, kind of leading into, why the CLO ETF, Peter? Like, what was the reason it really made sense for you? You want to, like, I think you found a niche that you saw in the market, and want to explain a little bit about that?
Yeah, I kind of coming back to my original comments, it was something that we wanted, right? It was something that we wanted access to as a retail investor, and something that it wasn't being provided. Hence the name of our firm, Alternative Access. It's about providing that the products that the big institutions are buying and they're putting your money into and taking your spread out of. Giving that access, giving the retail client the ability to purchase those assets. And the ETF wrapper makes a lot of sense, because it's ease of use, right? People can easily, they know how to trade equities, and just simply asking your broker to buy ticker AAA, that's pretty easy. You'd be like, hey, I want however much of AAA, and that's a pretty easy thing to do. And then also it's very transparent, right? I mean, we publish everything we're doing every day. You can see our portfolio every day, all of our prices, all of our assets. And so people can always see, hey, this is what this fund is doing. And we like the transparency. We think that there's a lot of lack of transparency in a lot of financial things, and we would rather provide that. And so from our perspective, AAA is very pure play, right? We are, in our prospectus, we're only allowed to buy AAA rated assets. We're not allowed to use leverage. We're not allowed to try to window dress any of the yield. The NAIC, which is an insurance an insurance rating system, gives us a 1A. And what that means is the NAIC, who kind of helps insurance companies manage their capital risk, said, "Hey, this is next to government treasuries. This is the least risky you can get." And so that's from a capital charge perspective.
That's
And
very
so,
good.
that's very interesting to us. And so when you combine an alternative asset like AAA rated CLOs and a retail product like an ETF, and you put them together, you have a nice union where people can have transparency, they can have access, they can get a great product, and it fits into kind of everyone's portfolio in some form, right? Because no one's ever going to be 100% invested in equities, right? I mean, everyone's always going to hold a little bit of cash. Warren Buffett always says he holds, kind of 10% cash, right? And that's where this product lives. That's where ticker AAA lives, and that's something that we have we put our grandmothers in. We like to joke around about that. But yeah, it's true. I mean, honestly, it's my mother, my grandmother, my mother-in-law. This is a great product for them. And father-in-laws and grandfathers and all those folks as well. And
Absolutely.
and even younger folks too, in a sense that, again, I mean, no one's ever going to be. You're always going to hold a little bit of cash, and in order to get a little bit better yield, this product is perfect for that.
Well, and Peter, as a financial advisor, I can just attest that when I look at my clients' risk score analysis, we use a system called Nitrogen, where it really details through their psychological feeling of what would happen when they see the positive and negative in their portfolio. And for financial advisors out there that are using that program, this actually has a risk score of 6 out of 100. Again, it is an investment. Uh, Peter did mention you can lose money like any investment you can, but to put it in perspective, typically the S&P 500 ranks about a risk score of about 72 to 74. So again, the nitrogen risk score for this particular investment is a risk score of 6. And I think you have some disclaimers, Peter, like you kind of bring up. And just remember, this is not an offer to buy or sell security. That can only be done through a prospectus. And I know Peter's going to be able to share his website. You want to share a little bit about your some disclaimers, a little bit about if you were to compare, like what do you compare the CLO to?
I mean, when we are, looking at comparisons, like I said, the comparisons would be the ultra short corporate space,
Mm-hmm.
short-term bonds, treasury bonds, intermediate treasury bonds. Those are the sectors that we're comparing to, in effect, broadly. And those, when we look at kind of how we, our index, our reference index, is the Bloomberg Barclays less than 5-year duration U.S. floating rate index, right? And since inception, we've outperformed that index by a good amount on an annualized basis, and that's interesting. The thing about that index. Getting access to floating rate bonds is actually quite hard, and actually, AAA CLOs is the largest floating rate AAA floating rate product that there is. So and so when all that comes together, it makes a lot of sense to have the product.
So if and on that point, Peter, if someone wanted to just go out and buy a bond, what are the typical sizes that you're purchasing in your portfolio that they may or may not have access to, where they can through like an ETF or exchange traded fund?
Yeah. Honestly, a retail person really can't buy a CLO bond. Because they are 144A, they're subject to regulations, minimum investor regulations. But an ETF can, right?
Mhm.
And so that's the benefit, is that we provide that extra layer, basically, again, access to the product itself. Um, you know, Minimum sizes in the CLO world, are anywhere from $1 million to $10 million, right?
Wow.
Uh,
Okay.
so I mean, they're not for retail clients, and hence why bringing the product into an ETF, giving people bite-size access is really interesting.
Yeah, perfect. Well, Peter, as an advisor, I'd love for you to go ahead and also share your disclaimer slides, before we head over. If you want to, for those that are watching it, you can obviously pause and read all the disclosures that, Peter has on the next few pages. But the big thing here is that there are opportunities out there. The floating rate it seems like a really interesting product, Peter. Really, share. So for financial advisors that may want to offer this in their portfolio, do you mind kind of sharing your website, how they can reach out to you, and so forth? And for those that are watching, we'll also just share that his website is www.aafetfs.com, and there is a contact page there. And Pete, just want to just obviously you can reach out, have any questions to see where that may fit into your clients' portfolios. For folks, retail clients that want to learn more about what it's like to work with an advisor, see how this may fit into your product, or even to see what your risk score is, we do offer a free risk score analysis as well. And Peter, you want to just show some other parts of your website real quickly?
Sure, sure. Yeah, no, we're at AAFETFs.com, as Michael referred to. And all of our documentation you could be found here: prospectus, summary prospectus, and all of our returns and whatnot. Details about the fund, they are all here for folks to have access to. So please feel free to reach out. You can contact us at the bottom of the page there. We'll be sure to follow up and get you as much information as you like.
Yeah, and those will also be in our in the comment section as well, as far as how to reach out to Peter and myself. For those that are listening, feel free to reach out by phone or text at 813-710-4123. Again, my name is Michael Mandarino. Peter, we're so glad you're here today. Thank you so much for your time. For more information, you can also go to www.123-investing.com. Thank you so much. God bless and have a great day. Thank you. Thanks again, Peter.
Thanks, Michael.
Any lasting comments before we depart?
No, no, just appreciate the opportunity, and go Army.
Go Army, beat Navy. Yeah, thanks, brother. Blessings. Thank you.